set some context, Jay.
All right, set some context. Okay, so a couple of years ago, I talked about this concept of peace of mind banking. It really kind of describes how I go about my business. And the reason why I felt there was a need for that is because I just felt there's a lot of kind of misinformation about what it is that banks do when they make lending decisions. And you know, whether some CFOs may have a deep capital experience, and some CEOs may have a deep capital raising experience as well. But I think many don't, because I hear people say, "Oh, banks aren't lending." So that was kind of what started to develop this idea. Mike encouraged me to kind of put some framework around it, and then I changed banks, and now I feel like I'm at a bank where I can really deliver on this value prop and this this ethos. And honestly, I kind of just sat on it for a couple of years, really. I mean, this has been my message to the market, but I want people to know that there's more substance to it. And so, it's weird. I mean, I can push through a lot of things. This has been a point of resistance for me. And so I'm coming to the group, and I want to breathe some life into this. It's how I have been operating my business, but the idea is that ultimately, what I'd like feedback on is this something that you think is worthwhile? Now, again, you're a CFO, so I would expect your knowledge around this area to be a little deeper than like a CEO or an owner operator. But either way, I want your feedback to say, no, either this is good or this doesn't make any sense and is not worthwhile at all. Or somewhere in between. So
perfect.
There you go.
Sounds good, my friend. Do it. So
okay.
I want to now get in roll and begin.
Yeah. So this is now we're starting it off here. So, well, Mike, first off, I appreciate the opportunity to talk to your group today, and from your guys' standpoint, I mean, you guys heard any good banking jokes lately? This guy walks into a Wells Fargo branch.
Yeah.
Oh, okay, no. That one's too easy. How about this one though? Banks will only lend you money when you don't need it. I mean, I've heard that one hundreds of times, literally. I've heard it hundreds of times. And I've also experienced it directly myself. Before even getting into commercial banking, my wife and I owned a small business. It was a Curves fitness franchise for women in Tierra Santa. So we bought this existing store, and we owned and operated it for a couple of years, and then we sold it. Well, when we were in the process of buying this business, a banker from one of the large banks had approached me and said, hey, have you thought about getting a loan? I said, well, no, I mean, tell me about that. I want to, what would it take? He said, well, let me get all your tax returns, all your information, I'll gather that stuff, and, then I'll evaluate the possibilities. And I said, well, hey, just so you know, we're just buying this business. Brand new business. He's like, no, that's good. Took all the information, a lot of effort to put that together, walked away, and then a couple months later came back and said, I can't give you a loan. I said, well, why not? Why can't you give me a loan? He said, because you just started this business. I said, I told you that 5 minutes into our conversation. What are you talking about? So that was where I came into commercial banking. And I said, you know what, guys, there's got to be some more clarity around this process. I mean, how complicated can it be? And so when I started my career in commercial banking, I joined Bank of America, and I'd always ask the more experienced credit people, I'd say, so what are the factors, like, what's most important when we make a loan? What's the most important? The answer was always the same. It depends. It depends. Really, it depends? I mean, really, is it that tough? So I was really frustrated by this answer, because that's what they would tell our clients. Well, it depends. I'm like, so anyways, fast forward 10 years, and what I've learned is that, it really doesn't, depend all that much. It really doesn't depend all that much. So I'm going to demystify this for all of you today and really give you the playbook on what are the factors that banks do consider. What is most important? Because at the end of the day, it really doesn't depend all that much. And then the beauty of this, and peace of mind, is that I'm going to give you the decision factors that I consider and banks consider when making a loan. So you're going to have those decision factors. It's about giving you transparency throughout the loan decision process. It's my commitment to you to candid and direct feedback And then ultimately that results in a quick response around potential options, whether that's the bank capital or some other form of capital. So you're armed with the information that you need. And I think the real beauty in this is, how do you distill a career of knowledge into one page? And to the extent that you can do that, that is a beautiful thing. So I'm going to talk about two different sets of factors, and they really do go down in order of priority. So the first set of factors is bankability. And these are kind of all your quantitative, dollar-driven type things. So number
Jay,
one.
Jay, could you go to the other side again, because,
Well, we'll just move it out here, move that here.
yeah. Thank you.
There we go. Is that better?
Yes, thank you.
Okay. So number one, trends. Specifically, are trends going up or down? They need to be going this way, okay? Number two, profits. Number three, cash flow. Number four, leverage, the amount of debt the company has. And number five, collateral, or we'll call it asset coverage. So those are the 5 things, and I would say in order of priority, that impact a bank's ability to make loans. And yes, there are some nuance and it can depend, but basically, if you don't have some substance around these items, the chance of you getting a bank loan is significantly reduced. Okay, so now that's one set of factors. The other set of factors, as I'm going to call, these are more qualitative, okay? So this is what makes up a company's industry profile. Number one, stability. Or I've also heard it called defensibility. How defensible is that business? Number two, competitive position. Are you number 1, 2, 3, 5, 10, 20 in the industry? Number 3, customer base or concentration. I see a lot of situations where a company does business with one very large customer. It makes it very, very difficult in that situation versus a diverse customer base. Number 4, management, and specifically the quality and experience of that management. And number 4, financial operations. And what that speaks to is the quality of the financial statements. Could be audited, and also just the financial operations in terms of how that's managed on a regular
You
basis.
mean
Now,
like speed of closure?
speed of close, reporting, all those sort of things. When banks don't receive financial statements on a timely basis, it's never a good thing. It's never a good thing. So these are all kind of more qualitative, and I would put them second to the bankability traits. Okay, so now what we can do is we can put this on a graph. So these are my bankability characteristics, and here are my industry profile. And if down here, I'm going to say this is early in this corner. This is transition, kind of in the middle. And this is stable out here. And here, same thing. So for a company, depending on where they fall in those factors, you can kind of start to graph this out. And you're probably thinking about maybe where your company is. So here, this is where my Curve business was, because it was very early. And so what was available to me? Well, it was equity, it was founder capital, it was seller notes, it was private money. I've heard it referred to as the 3 F's: friends, family, and fools. So this is your early, okay? Then, out here,
Which one are you?
we don't know yet. So in this area here, this is transition. It's kind of your in-between phase. And so if we can kind of think about some business in here, like a business up here might be a consumer products company that's super fast growing. So they have good financial metrics, but they're still very early on from an industry standpoint. A company out here, maybe they're getting impacted economically, but they've got long brand awareness. I think about the newspaper business. I think about retailers. Things like that. They're kind of struggling, but they're still very popular and well known. So the type of financing for these companies is asset-based lending, or ABL, mezzanine, which that's that kind of in-between form of capital. It kind of has flavors of debt, but also has flavors of equity. And then, of course, anything that's in this red zone in the early stage is also available. But the key is for any company to get to the green zone. And that's the bank debt. Because aside from vendor financing, this is the cheapest form of capital available. But in order to get there, you need to be high in your bankability characteristics as well as your industry profile. So that's the essence of peace of mind banking, giving you the playbook and the clarity to know where your company falls. And my hope is that that will give you peace of mind.
Show appreciation.
Okay, good mind.
Okay. Have we got all that? You want to keep that running?